Hello, everyone. My name is John Locke, and I'd like to welcome you to the Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We are not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, so please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are using hypothetical computer simulated trades and the results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary substantially from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today, I'm here to bring you into the realm of high probability options trading. This is also known as income trading sometimes, and sometimes known as positive theta trading. And it's where we utilize strategies with options to make money through the passage of time rather than depending solely on price movement in order to win. This means that we can often win whether the price goes up, down, or sideways. Now, this doesn't mean we're going to make money all the time, but it does mean that we're much more likely to win or make money than if we were to purely rely on the asset going in the proper direction in order to win. And today, I'm here to introduce you to a wonderful trading strategy called the quick and dirty broken wing butterfly. Now, the quick and dirty broken wing butterfly is an options strategy that I developed for our FIT program, also known as the Fundamentals of Investing and Trading library, that is included with our Go membership at lockeinyoursuccess.com. Now, the quick and dirty broken wing butterfly is a market neutral income strategy that we trade in the Russell 2000. It requires a minimum of $3,500 per trade. The example size that we're going to be showing you today is a $7,000 planned capital trade, and it has a profit target of 7.1% or $500 for the position size that we're going to be showing you. And it has an exit loss trigger of 7.1% or $500 based on the position size that we're showing you. So let's take a look at the trade. So for those of you who are new to this type of trading, this is an analytical software called OptionNet Explorer. It can be found on optionnetexplorer.com. And what it does is it gives you a risk profile of the position you have on, which is very helpful when you start dealing with more complex options positions. So regarding this risk graph, what we have here is the asset price along the bottom, and we have our profit and loss along the right side. We have a triangle-shaped, straight, rigid line here that is a representation of the profit or loss in our position at the time of options settlement at any given price point in the asset. And then we have what we call a T+0 line, which is the thinner line here that goes from red to blue. And that's known as a T+0 line, or the profit and loss that the position is likely to have at any given price point in the Russell 2000 as of today. So the other things that we have going on here, this is also a back testing software. So we can go back in time and we can take a look at what positions, what would have happened with certain positions and so forth. In this case here, we're back in time to May 20th, 2022. And on May 20th, 2022, we have an options expiration cycle here, which are listed across the top. We have our July, we have our July 15th, 2022, our July 29th, and our August 19th. Our July 22 is 56 days to expiration. The asset that we're dealing with is the Russell 2000, which is shown here. The asset price at the time was $17.57. And these are, again, our options cycles. We have our calls on the top. We have our puts on the bottom. These are the strike levels. And these are the positions we have on in relation to those strike levels. So our asset price is $17.57. We, with this strategy, what we do is we go in and we go approximately 20 points below the money. And in this case here, that would be 1740 strike. And we're going to sell some of those. and then we're going to do what we call a 50-point wing, or go 50 points down. And we're going to buy 2 options there. And we're going to go 40 points up, and we're going to buy 2 options there. That creates a position known as a broken wing butterfly. And if you take a look at the analytical graph, this is what the risk of that position looks like. So with this, we're going to enter this position. Now, if you're doing these types of positions, you should be with a broker who will accommodate an order of a broken wing butterfly. And that means we would put these options in all at the same time. We'd enter it as one order and they'd all fill at the same time. And also worthy of note here, this is a 2 lot. So in other words, we have 2 broken wing butterflies that we have entered. So with this position, what's going to happen is over time, this T+0 line is going to rise or tend to go into the shape of this expiration line. Eventually, it will be exactly the same shape of the expiration line. And if the market didn't move at all, and time simply went by, and we stayed at the same asset level, we would make approximately $4,500 in this position. Unfortunately, the market has a tendency to move, if you haven't noticed. And that being the case, this price is going to move around. And if it stays within a certain range, then we're just going to leave it alone. We're going to let the time do its thing. We're going to make some money. If it moves too far in either direction, then we're going to do something called an adjustment, and we're going to modify this position in some way in order to make it more likely that we're going to come out with a win on the trade. Now, the way we're going to do that is we're going to look at something called our delta. So our delta is the amount of risk we have with price movement. So currently it says we have a delta of 2.07. That means if the asset price goes up $1, then theoretically we're going to make $2.07. If it goes down $1, theoretically we're going to lose $2.07. And I say theoretically because we have other factors such as implied volatility, time passage, and so forth that are also going to affect that. But it gives us, it's not perfect, but it gives us a general idea of what we're going to be seeing for profit and loss with price movement. So why don't I talk about adjustments here for a minute. So the type of adjustments we're going to do is we're going to use this delta number for adjustments. If the position this size hits -3 delta, we're going to do an up adjustment. And what we're going to do for an up adjustment is we're going to move these upper long strikes somewhere, usually down. And that is going to create a change. You can see our model position. This, for example, would bring us from +2 to +4. If the asset price goes down and we start running into a delta problem to the downside, and our limit here is +5 for position this size, we're going to take this option here and we're going to bring it higher. For example, to 1790. As you can see, I go from 2.07 to 0.11. If it gets to the point where I cannot adjust the position within the delta where we are, then we're going to actually close the position and move it. If in this process we get drawn down $500, we exit. And if we get up $500, we exit. And we're going to be checking this position once a day. So it's not something you're going to sit there and watch all day. It's something that we're going to come in at our checkpoint time, in this case, 3:30 Eastern. We're going to take a look at what we have. If everything is within parameters, fine. If we hit an exit loss trigger, we exit. We hit an adjustment point, we adjust. If we hit a profit target, we exit. So let's move forward here. And I'll kind of go like 3 or 4 days at a time and show you what we have here. So if we come here to June 1st, and we're now 44 days to expiration. So we entered 56, we're now at 44, 12 days have gone by. And essentially the market in the last 12 days has gone up. And at this point, we're up about $152. The trade's going well. Our delta is within guidelines. There's really nothing to do here. So let's jump ahead another few days. Okay, so now it's June 8th. We're 37 days to expiration. So we've been in the trade for about 19 days and we've done nothing. We're currently at -0.37 delta, so that's within parameter. Our trade is up $222. Everything looks good. In many months, you don't really have to do anything. The market would probably drift around in this area here. We gain some money, we'd hit our profit target, we'd exit. This month didn't go that way though. So let's take a look here at what happened. So a few days later, on June 13th here, we have our asset price came all the way back down to 1712, which is below where we started, and it came down very quickly. If you take a look at the price chart here, you can see how fast, what was this, like essentially 3 days, we come all the way down. We came all the way from over 1900 all the way down to almost 1700. At this point, if we take a look here, we still don't have any problems as far as the position goes. We're down a little bit of money here, actually. We're down $68, which is no big deal. Our delta is positive 3.61. That's within our 5 parameters, so nothing to do. So let's move ahead. And when we come to this day here, Thursday the 16th, we have an 85-point down day in the Russell, which in itself is just a huge, huge move for the Russell 2000. You don't get too many days you get moves like that. And if you look at our price chart, you can see the aggressiveness of this down move. Again, this is a market neutral strategy, so you can get drawn down with these large down moves. But we're at this point here, here's the situation. We're down $308. That's within parameters. We are positive 7 delta. That's outside of our parameters. It's too high of a positive delta. So that being the case, what we're going to do is we're going to need to make an adjustment. First adjustment we're going to try is to do one of these. When we do that, that brings us down to 5.05. That's a little too high. So I'm going to do 2 of these. And that brings us down to 3.08. That is within parameters. So what we're going to do is we're going to make that trade. And we're going to put that in as a vertical. And when you do that, this is what our new position looks like. We're now within our delta limits. We're within our profit and loss. Everything is fine. So let's move forward, see where this goes from here. If we move ahead to June 21, we've almost recovered from that. Time has passed, implied volatility has improved, and we are sitting here nicely in the center of the position. Let's go a few more days. When we get to June 24th, what's happening is profit and loss, we're up $48. That's fine. Our delta is minus 4.2. We only allow minus 3. So that being the case, we would make an adjustment here. So what we're going to do is we're going to move this back. And if we do that, that puts us at 0.98. So that brings us within parameters. So we're going to make that move. And this is our new position. If we move this ahead to June 30th, the market comes back down again. So we're getting chopped back and forth. We had this really, really big up move. Now we had a really, really big down move. And then we had a good size up move. And now we're heading back down again. And now we're going to have to back out of our adjustment. And, that's okay. So what we're going to do is just going to -1 + 1. That's going to bring us to 271 positive, back into this symmetrical butterfly position. And let me clear that. Show that. So now we're back in parameters and we're $229 positive. We have 15 days left potentially in the trade here. So why don't we move ahead a few more days? All right, so we get here and it is now July 5th. We're 10 days to expiration. We've been in the trade 46 days. And one of the guidelines here is we can exit 10 days to expiration if we'd like to. If we were to do that, our position would be up about $480. And that's a good return. That's very close to our $500 profit target. We're also allowed to stay in the trade. If I was going to stay in this trade, I have to look at this and I have to say, well, I'm at -3 delta here. So that's over my limit. To correct that, I'm going to move this long strike from 1790 to 1780. That brings me to 0.92. That puts me back within limits. And I would make that trade as a vertical. And that would look like this. And then I would wait till the next day. So if I do that, and I go into Wednesday, July 6th, what ends up happening is my position is up at $672. And that being the case, that meets our $500 profit target or profit objective in the strategy. And we would exit the strategy at about a $670 profit. And I believe that would be about 9.6% of planned capital. But here's the wonderful thing is if you take a look and you go back and review this video, you will find that we only had a maximum amount of capital in this trade of $2,018. That means that our return on actual capital in this position, again, this was a tough position to be in this month because we had to make multiple back and forth adjustments. Our actual return on capital is 33% on a simple, easy to execute, broken wing butterfly style strategy. And that is why our strategy is in our Go program. And it's also why I love the quick and dirty broken wing butterfly, this episode's winning trade. If you love what you see, and who wouldn't, I invite you to come on over to lockinyoursuccess.com. That's LOCKE in yoursuccess.com and check out our Go membership where you can find the quick and dirty broken wing butterfly along with 3 other fantastic trading strategies in our fundamentals of investing and trading library, which is included in our Go membership. Also, where you can follow 12 powerful income strategies as they unfold during our weekly options trading for income webinars. While you're there, make sure you check out the winningtrade.com, where you can find past winning trades, find out about upcoming winning trades, and find free bonus material. And perhaps best of all, you can check out our free trading performance podcast, where you can learn to skyrocket your trading results, regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see in the next winning trade, please put them in the comments below. I'll make sure I answer any questions for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.